took me really long to figure out how to do this crap on just anyways, I'm not on my normal desktop, and this is gonna be one of those drink and talk sessions. So Fed bought a lot of commercial paper. Well, they offered to buy, so that's actually important. So why is that important? We know that if you just look at SPY, Fed did something over the weekend and that didn't work. Why that didn't work? Well, there was a drop of what? Something like 16%? Sorry, 11% or something like that. So it was some ridiculous drop. Yeah. And during the weekend, Fed said, okay, we're gonna lower the rate down to some like 0%, basically between 0 and 25 basis point. And at the same time, they're like, all right, we're gonna offer to buy. They basically provided a repo facility and then said, okay, we're gonna essentially let you offer to buy some treasuries at whatever rate that is. Not really buy, like you can essentially collateralize your let me just see if I can see the comments. Okay, that's fine. Anyway, never mind. So they offered to let you collateralize your treasuries and lend you cash, which is what you need. So that wasn't taken too kindly by the market. If you were paying attention, you knew that the at the end of the end of last week, we ended on 27,000 and 27,700, and then by the time the market closed on Monday, we were at 24,100. So the market really didn't like that a lot. And by I don't remember exactly when that news came out, but essentially Fed says, okay, we're gonna buy commercial papers. And I think that made all the difference. So why that is different, okay? So the standard repo, at least by the Fed, normally they were like, okay, give us, I think they only take treasuries or sometimes even agency paper, like agency debts, and they're like, okay, so if you promise us, what repo means is if you promise me that you will buy back the stuff that you have just given ownership to me in whatever day, typically overnight, then I will give you such amount of cash. And if you don't end up paying me that cash back plus interest, I'm gonna keep possession of whatever assets you have collateralized, and then give it to me. That is essentially how a repo works. It's all over the world. I mean, banks do repos, and then you have Fed obviously does repo. Let's read what Fed did differently this time that caused the 5% market pop. Right? So the Fed Reserve has threw a direct lifeline to corporate America on Tuesday, saying that it would begin buying commercial paper. Here's a different thing, through a facility that last invoked during the 2008 financial crisis. Okay, so we are already seeing they're picking up tools from 2008, right? So, but I think it's actually a good tool. I will see why slightly later. So the the commercial paper. What is a commercial paper? Commercial paper is basically a bunch of it's short-term borrowing by typically large corporations. Because if you are not a large corporation with very good financials, um, nobody trusts your unsecured liabilities anyways. So they're not gonna lend you money. If they do, they're gonna charge you a ridiculous amount of interest. So you typically don't do that. So who would issue those? A GE, GM probably can't do it, or if they do, they probably don't get a very good rate. Disney, Coca-Cola, these companies are things that you would consider with steady cash flow that have no problem of paying their debt, at least in the short term. So these are the guys that issue commercial paper, and obviously they have to pay an interest on it, but typically that interest is very closely tied with the whatever the prevailing rate is. What does that mean? Commercial paper is typically less than 270 days, but typically even less than 90 days. So they would pay typically slightly more than the government pays for the same duration. Obviously, there is a slightly higher chance of these guys going bankrupt than the government. You might argue, but the government has many debts and they will go bankrupt any day. We have a large amount of deficit spending, blah blah blah. But in the end, the government has the printing press at its disposal, and nobody else does. So, a government who can print their own currency cannot ever default on their own currency, on debts that's denominated on their own currency, which is U.S. is basically never going to default on their debt technically, but they will just pay you with slightly more worthless dollar than you were giving them when the deal was signed. Obviously, that's not the case with all the European countries. That's why you have the whole fiasco with Greece and all that, right? Because Greece can't print its own currency, and well, it's not only Greece. If you have debts denominated in other currencies, you cannot pull the same trick, which is why Argentina has to pay like 8% plus for their 100-year bond in 2017, which is still completely stupid. Why would you trust Argentina for 100 years? I don't even trust them for 3 years. So pay me 33% and then we'll talk. Anyways, so why is this much better than their repo deal, right? They were like, oh, I'll do some crazy repo, we'll do quantitative. Yeah, quantitative easing is the same thing. Repo is basically, I will take your collateral and lend you money, and QE is basically, the reason they're not calling these operations QE previously was that they were not buying things. They were just lending money with a collateral. So now they're like, we'll straight up buy bonds. But what bonds are they buying? I remember in 2008 they were buying more than just government bonds. They were also buying mortgage-backed securities. I'm not sure if they're doing that now, but in any case, that's not the problem with the market at the moment. The market, I mean, the housing market is not under any stress. There's not large amounts of subprime loans made to unworthy homeowners, if I call them that. But like, what the market has problem now is this. So okay, so how is this bad? It doesn't look really bad. The curve looked like it was going up and then was going down. So nothing particular to be looking at. Nothing particular to be watching for. So But what you need to do is then you need to check against the 3-month damn it, it's called the Treasury 3-month. Oh, come on, where's my 3-month? 3 months. 3-month Treasury bill. Constant maturity. So we're just basically saying if it's like 3 months of constant maturity. So it's like if you somehow artificially kept things as 3 months. So we add that in, and then we do a subtraction, and then you would see where the stress is showing up. And these are the interest. That basic what I'm doing here is basically an interest rate spread. Okay. I mean, already you can see there's some weird shit happening in here, and some weird shit happening in here. So what's that shit? This. What does this mean, right? So these are supposed to be fairly close-ish, and it's over the long term. It's supposed to be slightly above zero on money, and then the corporations again. So over the long term, they will be slightly above zero, and you have see these anomalies here, right? You're like, but why? In 2018, these companies were paying basically less than Treasury. Well, the reason is, if you think back to 2018, we had rate cuts, and that's just front running the rate cuts. And as soon as you cut rate, which is the Fed fund rate, then it would directly pull down the Treasury rate. Because now you can borrow money from the Fed at blah interest rate, let's say 1%, and if you had a Treasury, let's say at 1.1% or 2%, then you would just buy the Treasury at the same duration. Especially on the short end of the curve, you don't have much duration risk. You say, like, I can buy the Treasury that gives me 1.5%. That's a good deal. The only thing that's limiting the infinite arbitrage is that Fed is not going to lend you 100% of the money that that your deposit, your collateral is worth. So you already own some bond. I'm talking about basically these money the dealer banks. Right, so the money dealers will be like, all right, so I already hold some Treasuries that is paying me 1.5%. Imagine it was 1.5%. They're like, oh yeah, I'll deposit that at the Fed and tell them, all right, I want to take out some loans. Give me some loans. Or they could just lend it to. They could do that. The same thing with other banks. They're like, give me some loans. So here are some Treasury bills that are not going bankrupt. That are going to be paid. So even if I don't pay you back, the government will, because you will take possession of the Treasury bill that I currently have, and then I will take some money out, and then I will use that money that was taken out and buy more Treasury bills, because that's yielding more than what I'm paying, which is 1.1%, right? So that's what these guys do, and then if they have an expectation of the Fed lowering the rate, then they will be like, all right, I will run a bit of risk, and I will buy Treasuries in advance, which will drive down the price, and that's these things. And late last year in September, we hear these repo craziness. If you guys might have heard it, but there's some talks about repo craziness. Essentially what was going on was the overnight repo rate went bonkers. It was just much greater. It was paying 2% more than the than Treasury. Well, if something's paying 2% more than Treasury, then basically you're saying that this thing has at least, well, this thing has like 2% chance of going bankrupt. But these, as I said before, were very credible, large organizations. These are Coca-Cola's. Well, do they have a 2% chance of going bankrupt? I don't think so. So something else is at play. I don't know exactly what the hell is happening, but that typically signals some kind of dislocation and money is tight. At least on the short term, money is tight. Whatever that money is, but money is tight. And this is happening again. This directly impacts these companies' ability to fund their operations. Well, you would say, okay, what the hell is going on? Why do they need to borrow in order to operate? Well, because these were good credit companies, they were like, okay, I have to leverage on my good credit, so I will borrow more money at low rates, and then that way I don't have to have my own capital, which is the equity part, in use to fund my inventory, my payable. Payable is basically someone's gonna owe you money, right? So your clients owe you some money. They have a term which is typically, trade terms like 30 to 90 days, something like that. They owe you money, but you have a fairly good. You're fairly confident that you're able to get these money back. You're able to collect. So in that case, you're like, why do I have to put my own money on the line? Why don't I just borrow someone? And then, as you can see, they typically pay very, very little over what the government pays. So then you're like, all right, so that's a good deal. And then that's what they do. So basically, they don't have enough cash on hand. They just rely on commercial papers. That's all fine and dandy until you hit this. And that only lasted a few days, really. And then the Fed announced that they would have like a special repo, like facility. Essentially, they're like, all right, so if you're able to give me things of good quality, I will lend you money. And that's what's going on here. I'm not sure if they did. They probably didn't do that on commercial papers. They probably just did that on treasuries. And that didn't work. They did that again, right, a couple of days ago. So I think it was like last week sometime they did that again, but that didn't help. Now they're like, oh, we will take commercial papers straight away, like just commercial papers. So that means they can now, the people that hold the commercial papers, which are typically money dealers and, well, paper dealers. You can read it yourself. But essentially, these are banks. Banks would take. So these companies would tell the banks, all right, I need to sell some commercial papers. And the banks said, all right, fine, I'll find you some investors that will take it, because the banks won't buy it themselves, because they're not in the business of holding these kind of securities, for two reasons. One is, well, for basically one reason, it's just inefficient on their balance sheet. Because the bank's asset should be generating as much income as possible, at the same time be deemed as little risky as possible by, at the moment, either the Fed or BIS, Bank of International Settlements, and they have some of these Basel III shit that is supposed to protect us, which it probably does. Anyway, so that's all fine and dandy, and then, typically it just works as intended, and you have some weird shit going on. And the important part is, if you look at the period of turmoil, you will see that this shoots up quite a lot. During 2008, 2009, you would see that people were paying 2% over 3-month treasury. And this is a signal when things are pretty bad, because even people with very good credit, not people, companies with very good credit cannot obtain credit. And that's, remember the talk about credit crunch? Well, I guess most of you probably don't. In the beginning of 2008, I still remember I was in the second year of, well, the first year of university, really. For first slash second, it was a summer. And there was a talk about a credit crunch until it turned into like a full-blown financial crisis. So that period from September 2007 and all the way down to here is, at that point they were saying, okay, the crisis is contained. All we have is a credit crunch. We just need to fix that, right? But it's basically, it's not good. Basically means people that should be able to borrow money cannot. And we have the same thing here. And they brought out the same tool that they did back here. Now, well, why do I think this is good? I mean, it is one thing to argue that these shitty companies should not be able to obtain credit, but it's another to say that even the good companies financially should be penalized for essentially an inelastic supply of money. Somebody is getting really jittery. By somebody, I mean the paper dealers. These guys are getting jittery and they don't want to lend. It doesn't matter how good of a credit you are. And so what happens is basically they will buy these things and they will sell it to investors, right? So they just don't want to buy. They don't want to buy, and then what happens is the money gets super tight and things go crazy. So this would restore economic activities if they actually manage to keep the funding cost of the operations of the good credit companies, to keep that going. That's good for the economy, short term and long term, not just short term and long term. So I think that's a very good move. I think, and that kind of explains why stock market went up. Wow, 6% now. When I was looking at it, it was like 4 and something. Anyway, that's actually very good. But does it fix the underlying problem of the stock market? No. But is that their target? I would say hopefully not. I would want my central bank to keep an eye on the economy, not on the market. The market is supposed to be a manifestation of the expectation of the future of the economy, not the other way around, right? You should not target the market; you should target the economy. So I think that's a good thing, but does that fix the market? No, it's still overvalued, and the economy is still, at least it's still going to go into a recession. There is no way outside a massive fiscal stimulus that we're going to avoid a recession now, because monetary policy only works if there's so someone wants that money to invest, and that's the only way you can get the monetary policies to work. Somebody has to borrow that money. On the other hand, if you have a fiscal policy, then it doesn't matter, because the government is spending the money and creating demand without the reliance of anything else. They can just borrow and I'm gonna spend it, and then somebody's gonna build that road for me, and it's just a lot more effective than monetary policy, from my observation of the world. So yeah. So that's all I have for today. We'll see if we have any. Let's see if we have any comments that I need to address, and I'll go to bed. Blah, 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 blah. First select, thank you. And I have a thing that says unable to connect to chat. That is so useless. Oh, here we go. Dalio says that drop market could itself worsen the recession. Yeah, I would agree with him. When the market drops, there will be a contraction of balance sheet all over, and that's why you see gold drop as well, because we are in a period of panic, and typically in periods of panic you would expect gold to do well, and gold did, until things got really bad and everybody's like, oh shit, I'm getting I'm getting closed out, my getting margin calls, and what I'm gonna sell. And if you're having positions of not even tens of millions, just if you had $1 million of stock on anything, you try to sell it, unless it's Apple, it's pretty difficult. So it is just pretty difficult. So you sell something that's liquid and hasn't gone down. Like, otherwise, you selling will drive the price down and trigger more margin calls. It's just, so that's why gold is down. At least that's my interpretation of why gold is down. But I still like gold. Stimulus will not save us from recession. No, stimulus will not save us from recession. But stimulus will... It's not a stimulus. At the moment, it's not. I would not say it is a... We don't have a stimulus yet. We might, because Hong Kong already started helicopter money, and Australia is talking about the same. US, Mnuchin just said putting checks into Americans, so that sounds like helicopter money to me. That might happen. These things, I do somewhat think that could prevent a recession, especially if you make these money not investable, and that just creates demand. It's like a forced demand. China's doing this. Oh yeah, China's doing this now. So there is a city called Nanjing, which they're giving. I don't know how they're distributing it, but they're giving 300 million yuan of, what do you call these? So almost like a gift card, except you can kind of buy everything. But it's not money in the sense that you can't invest anything. But if you really try, you can buy something and resell it and then get the money out and then invest that. But then you have to kind of take a loss. But that's beyond the point. Most people don't want to go through that trouble. Nanjing probably has something like 7 million people. So you're talking about like $10, 300 million yuan. So you're talking not too much, maybe 30, 40 yuan per person, evenly distributed. I don't know how they're distributing it though. So a lot of more cities in China is considering the same thing. Do you think it could spiral to 2008 situation? Yeah, but we could get into 2008, but I don't know for certain. There is a possibility. Time to buy. I'm not buying. I thought you were talking about people buying real paper, like customer in... No, not those paper. People just need liquidity, so they sell whatever. Yes, that's true. Holland as well. The government is going to give closed shops and staff financial. Yeah, I think Italy is suspending payment of mortgage, but I don't think that helps though. At the moment, if you suspend payment on mortgage, then, well, in this system, you either hurt the banks or hurt whoever is holding the mortgage-backed securities that the banks sold. which is most likely some older people that's relying on the income to live another day. But so bleh. And if you say, oh, I'm gonna suspend rent payment, well, what if your landlord is relying on that income to feed himself? So, what do you think about stock market in Switzerland? Have you ever? I haven't really thought about the market in Switzerland. I've looked into a couple companies. I think I don't even know if I'm pronouncing it. Roche. I think that company is fairly interesting. But otherwise, I'm not particularly into Switzerland. Uh, Thanks for doing thoughts. Where precise combination of data is the best. Well, it kind of changed from recession to recession, but typically, I think 3 out of the 5 large bear markets, commodities turned first, and then stock followed. The other way, they were at least according to Russell Napier, he was analyzing, and it was just um, volume. So if volume gets really low with low prices, nobody's wanting to trade. That typically signals the approach of a bottom. Here, postponing. Yeah, China did that. China is, at least from my perspective, they're saying don't pay social security for your employees, because in China you pay that for your employees. Basically, they're saying don't pay that for 3 months or something. Do you expect a further drop of to 50%? It could totally happen. I'm not buying yet. So Chinese stocks IQ. Well, I know IQ, but I have no particular. Because you would imagine that IQ is like YouTube. It's not. It's more like Netflix. So, and then on the other hand, like the Chinese take everything to an extreme. Netflix pays a lot of money to make shows, while the Chinese video players pay even more. So I don't know. It could be they could win. They could also destroy a lot of capital. Do you have any short? Yeah, I'm short SPY. I'm short India. I'm short. What else? I'm short. Oh yeah, I have $800 short on my old company. I thought that price is gonna drop like crazy today because a lot of old employees finally, the old employees who got the money before the IPO, who's still employed by the company, finally can sell 90% of their shares today. But the drop did not happen, so I'm gonna lose my $800 in puts. Oh well. I'm also short VGA, which is the. Oh yeah, I'm also short Australia and VGA, which is Vanguard Europe, I think. What do you think about Japanese future high debt, low growth, aging population? It's just gonna be like that forever. In Japan, it used to be that these vending machines would sell 100 yen drinks. Now they're like in the center of Tokyo, or I think even in Hokkaido, these were like 140, 130. I mean, even if you subtract the increased sales tax, which came in effect not too long ago, it's like 5 years ago or so, it's only 10%. So there's still plenty of inflation there, which is, yeah. What are you? I have a put. I've shorted all these through puts. My put expires by the end of the year. So, what do I look for before I cover my put? I don't know yet. no plans. Um, it it just feels like the people haven't settled down yet. There was no desperation. I don't sense desperation. I sense fear. I sense surprise and a bit of denial, and then just a bunch of people talking about bottom fishing, um, both in China and outside China for the U.S. market, even though historically it's still expensive. I mean, valuation isn't everything, so I could be wrong, but I- there's still plenty of optimism. So not, I have no plans of selling my puts. Alright, so that's all from me today. I shall go to bed. I finally made the first incarnation of my program work. So we were doing this no code mobile app development thing in my company, and I have a really shitty version of that that actually works. We built our first app out of generated code. So that was quite exciting. But that's not what you came here for, because that's not investable. And plus, the company has a 90% plus chance of dying because we have limited amount of funding, and we have a shitty market at the moment. So I might just, by the latter half of the year, I will may have to abandon the company, even though we have made quite a bit of interesting things now. So such is life.